Hi there and welcome back. Today we're diving into a topic that could transform how you build wealth, and that is index funds, specifically ETFs or exchange traded funds. They are a powerful investment tool, but they also come with some unique tax challenges here in Ireland. In this video, we will cover why index funds are a great choice, the unique tax rules in Ireland and what you must know, and thirdly, we'll look at how to make the most of your investments and to begin your ETF journey. Stay tuned. Hi, I'm Kevin Elliott. I help educate and empower people to make smart financial decisions, enabling them to build and preserve true wealth. Subscribe to the channel to learn more about optimizing your finances and achieving the financial independence you deserve. All right, let's dive in. What are index funds? Let's start with the very basics. An index fund is a type of investment fund that aims to mirror the performance of a specific market index, like the S&P 500, the FTSE 100, or the Euro Stock 50. Think of it as a basket of investments. Each basket is filled with the same companies that are part of the chosen index. Take the S&P 500 as an example. This index tracks the 500 largest companies in the United States by market capitalization. When you invest in an S&P 500 index fund, you're essentially buying a small slice of each of the 500 companies. Think names like Apple, Microsoft, Amazon, Tesla, Alphabet, etc. You don't need to pick and choose which companies to invest in individually. The index fund does that for you. Index funds are passively managed, so this means there is no active fund manager trying to beat the market by buying and selling stock. Instead, the fund's goal is simple. It aims to replicate the performance of the index that it tracks. So let's say the S&P 500 goes up by 10% in a year. The index that's tracking the S&P 500 will aim to deliver the same 10% return minus any small management fees. And here's the beauty. Matching the market often beats trying to beat it. Why index funds are so powerful? Number one, diversification. Diversification spreads your risk. So for example, investing in the S&P 500 means you own a small slice of each of the 500 companies. If one company struggles, the others help balance it out. So say you hold direct stock in NVIDIA, the chip maker. If the share price takes a sudden fall, it will have a material impact on your overall investment portfolio. Alternatively, if you hold NVIDIA through an index fund, the impact from a sudden sharp drop will be no more than a blip. And why? Because the fall of one company is cushioned by the other 499 in the index. Diversification is a safety net. It protects your portfolio from the unexpected. Number two, outperformance over time. Here's a fact. Most active funds fail to beat the market. Over a 10-year investment horizon, 80% of active funds fall behind. To prove this, we can look at the famous story of Warren Buffett's €1 million bet with Prodigy Partners, a hedge fund in New York. In 2008, Buffett bet that over a 10-year period, a simple low-cost S&P 500 index fund would outperform a portfolio of 5 actively managed hedge funds. At the end of the bet, in 2017, the S&P 500 had achieved 125% return, whereas the 5 hedge funds had averaged about 36% over the 10 years. Buffett's simple passive investment strategy crushed the complex high-cost hedge funds. The winnings totaling $2.2 million, thanks to compounding, were donated to charity. This bet became a landmark example of why Buffett advocates for index funds over actively managed funds for most investors. Index funds win because they don't chase trends. They just stay steady, and steady wins over time. Number three, lower costs. Actively managed funds have high fees. You're paying for the fund manager and all their teams, the researchers, the traders, etc. Index funds, on the other hand, have super low fees. Fees can have a significant impact on your long-term investment returns. Even a small difference in fees can lead to a drastically different outcome due to the power of compounding. So for example, over a 20-year period, a portfolio with low fees, e.g. 0.2%, grows much faster because most of the returns stay invested. This is represented by the green line here in this chart. A portfolio with high fees, e.g. 1.5%, see a large portion of your returns eaten away by costs, reducing compounding over time. This is represented by the broken blue line. So let's look at the numbers. Let's say you invest €100,000 with a 7% annual growth rate. At 0.2% fees, which would be typical for an ETF, your portfolio will grow to about €372,000 after 20 years. This is represented by the green line. At 1.5% fees, which would be typical for a managed fund, your portfolio grows to about €291,000, represented by the broken blue line. That's approximately €180,000 eroded in the value of your investment just due to fees. This is represented by the broken purple line. Lower fees mean more of your money stays invested, allowing compounding to work its magic, dramatically boosting your long-term portfolio growth. The tax implications of ETFs in Ireland. Here's where things get tricky for Irish investors. ETFs are taxed differently than direct shares. ETFs are taxed based on a system called deemed disposal. Revenue apply tax on your gains every 8 years from the anniversary of the date that you first purchased, even if you don't sell. Yes, you heard that correctly. It's taxed on unrealized gains. And are you ready for more bad news? The tax applied is called exit tax, which is 41%, much higher than the 33% on capital gains. This visual illustrates the mechanics of deemed disposal. A tax-free growth rate is represented by the green line. The impact of the 41% exit tax on the portfolio value is represented by the vertical red line. And the new baseline after tax investment value for the next 8-year period is represented by the black line. Once the tax has been deducted, the investment will continue to grow for the next 8 years, but at the new baseline. And the cycle continues for as long as you hold the ETF. So let's look at a simple deemed disposal example. Say you invest €10,000 in an ETF. By year 8, it's worth €15,000. You'll pay 41% tax on the €5,000 gain, so you pay €2,050 in tax. But here's the kicker. Let's say the index falls in value back to the original €10,000. You've paid tax on a gain you no longer have. And essentially, you've paid tax on a memory. The impact of deemed disposal. So let's look at the impact of deemed disposal on investment growth. Assume we invested €10,000 in the S&P 500 in the year 2000. Leveraging the actual historical S&P 500 growth rate, it'll be worth $50,724 24 years later in 2024. This is represented by the orange line. In 24 years, there are 3 deemed disposal events where exit tax will be applied to eat away at your return, and this is represented by the broken red line. Without deemed disposal, the €10,000 grows to $50,724. With deemed disposal and the repeated taxes, it shrinks to €28,859. That's approximately €12,000 lost just because of the exit tax. I appreciate we're comparing a scenario with and without taxation, which is unrealistic. So let's compare the impact of exit tax at 41% versus capital gains at 33%. Now the orange line represents the scenario where you hold a fund for 24 years. It's worth $50,724. But after we apply capital gains tax, the proceeds are worth $34,027. And remember, with deemed disposal, represented by the broken red line, the value is $28,859. Even comparing capital gains versus exit tax, your investment is approximately €5,000 worse off because of deemed disposal. To make things worse, unlike with capital gains, for exit tax, you cannot offset losses in an index fund against gains before applying your tax. So now for my monologue, my thoughts on deemed disposal. Deemed disposal, or any tax on unrealized gains, is crazy. We could have a situation where the index fund plummets in value the day or week following the deemed disposal event. In that scenario, you've essentially paid tax on a memory. deemed disposal taxation in Ireland creates significant challenges for long-term investors. By imposing taxes every 8 years on unrealised gains, this policy disproportionately penalises index funds, one of the safest and most diverse investment options available. This not only undermines the attractiveness of index funds, which are lauded for their low fees and broad diversification, but it also pushes investors towards riskier alternatives, like stock or property. These options come with higher volatility, concentration risk, and often require substantial capital and expertise to manage effectively. Additionally, some may feel compelled to invest in actively managed funds with higher fees and higher risk profiles, which can erode longer-term returns. The taxation system ultimately discourages prudent, diversified investing, potentially putting the financial security of Irish investors at greater risk. It's time for the Irish government to reconsider how index funds are taxed. A more equitable approach would encourage sound financial planning and help citizens build wealth responsibly while fostering a stronger culture of long-term investing. Without this change, we risk driving investors away from safe, efficient and diversified vehicles that align with global best practices in personal finance. Deemed disposal is a major obstacle in preventing people in Ireland from taking more control of their personal wealth. How to get started? Now you've considered all the important factors for an Irish ETF investor. Deemed disposal, no loss offsetting, self-reporting obligations, UCITS that are euro domiciled versus non-euro domiciled, and currency risk. And you still want to proceed to purchase an ETF. So let's look at how to do that on a platform like 𝐬𝐮𝐬𝐫. So on 𝐬𝐮𝐬𝐫, search for an ETF. So let's look at a couple of examples. You've got the Vanguard S&P 500 ETF, the ticker VOO or VUSA. This tracks the S&P 500. Another is the iShares Core MSCI World ETF, ticker IWDA, and this offers global exposure. Then you've got the SPDR MSCI Europe ETF, ticker SPEU. This focuses on the European markets. Look for UCITS compliant ETFs. This is that they're euro domiciled. These are generally more tax efficient. So the next part is to evaluate your options. Check the total expense ratio, or TER. This tells you the annual cost of holding the fund. So look for a fund that with an expense ratio under 0.3%. Review the fund performance. Look at its history, the dividend policy, and also the index that it tracks. Confirm that the ETF is traded in euro. This will help to avoid any unnecessary currency conversion fees. Now proceed to order. Go to the trading section of 𝐬𝐮𝐬𝐫 and enter the ETF ticker symbol. So remember, for example, if Vanguard S&P 500, the ticker is VUSA. Decide how many shares you want to purchase or the amount that you want to invest, and then select the order type. You've got a market order, which is buying at the current market price, or a limit order, which sets a maximum price that you're willing to pay, and hit buy. And that will lead you to commence your journey to being an ETF investor. Conclusion. ETFs offer diversification, low fees, and global exposure. And they offer peace of mind that enable you to set and forget. But Ireland's tax rules, especially the deemed disposal, disproportionately penalise index funds and erode long-term returns. But the S&P 500 has almost doubled in the last 5 years. If you marry that with management fees that are typically 90% lower than a managed fund, even with deemed disposal and an exit tax of 41%, I believe that index funds can outperform managed funds over the long run. Thank you for watching, and if you found this video helpful, hit the like button and subscribe for more investing tips. If you have a question or a topic that you'd like covered, please drop it in the comments below.